Hello and welcome to a brand new show of Market Makers. My guest on the show today is Nirmal Jain, Chairman of IIFL. Nirmal, great to have you back on ET Now. Thank you for joining us. Nirmal, Indian markets have appreciated by about 25% plus this year, about 8% in last 1 month. Do you think this is as good as it gets, or this is beginning of good times?
I think it looks like beginning of good times, but the caveat is that politically things should not go out of control and reforms should continue. In fact, what had happened that from 2008, markets had not moved up. In fact, they went down, although the earnings were going up. Earnings continued to move up. I mean, not at the pace of 20-25%, but at least at 12 to 15%. So markets have a tendency to move in cycles. So they are trying to catch up in terms of PE multiples. And this sudden burst of reforms came as a huge pleasant surprise because nobody was expecting this government to have courage to push through reforms at this pace. And I think the key trigger, of course, as all of us know now, was the diesel price hike and no rollback on that, because when the diesel price hike came at 5 rupees, everybody thought that this is a negotiating stance and maybe they will roll back at least half of it. So I think that has given a lot of confidence to foreign investors, FIIs in particular. And this also has been supported by the fact that China is slowing down at a pace faster than most of the FIIs had imagined. And so as an investment destination, there are not too many alternatives to India. So people want to invest in India because they look at, fundamentally a good story, a democratic setup and a judiciary which is independent. So which is a very good setting for foreign investors. But they're always worried about the political situation. And, when government demonstrated that they can move forward, I think foreign investors, and we have seen that. I mean, that is all reflected in FI money and the numbers, that we are seeing week after week.
So how much of the current rally do you think is a function of local news, and how much of the rally is a function of global risk-on rally? Because if I look at Europe and if I keep China aside, other markets also have done reasonably well.
That's true. But, between the local and global factors, it works as a multiplication model rather than the, addition. So, it's not that in 100 we can say 50-50, but it becomes 10 into 10. So, even if global factors are very good and your domestic factors are zero, then zero multiplied by anything, you won't get any money, because for the investors, what they want to look at is the risk. So whether the risk is local or global, they will run away from it. So I think for a long time or for quite some time, we had a situation when global factors are conducive in terms of liquidity. Liquidity has been very benign. There's a lot of money that can chase stocks in emerging markets. But unfortunately, things were not moving back home. And that's what, had held back foreign investors. And now, both the things are in place, so things are moving.
For those who are working with the assumption that before this year end, and when I say year end, calendar year end, Indian markets could kiss a new high, will they get it right? Will they get it wrong?
I think from a bull's point of view, they should be happier if they get it wrong, because if the market runs up too fast, then there's always a risk that some negative news or some negative event can make correction also very steep. So it'll be healthy for the market if it moves up steadily, even if it touches 20,000 by the end of this calendar year, and maybe the new high by the end of this fiscal year, or maybe around new fiscal year. That is a much better scenario than markets running up too fast. And I'm sure that there are a lot of factors that will hold back the markets now at this point in time, because a lot of major reforms have already happened. Politically, things have become again a little challenging and fluid. And the corporate earnings which are going to come, there'll be a lot of question marks and apprehensions about negative surprises. So it looks like that October is the month when markets may take a breather, and then they'll resume, their direction maybe in the month of November.
Now, Indian markets for this calendar year, they've been extremely polarized. So it's select FMCG, a lot of pharma, and some price action in cement, or I would say price action in a lot of cement stocks. Now that reforms have kicked in, sentiment has improved. Do you expect this polarized nature of the market will change?
I think, if you notice, then PSU bank stocks also have moved up from their low levels. But there is still apprehension, and I think the first phase of reforms, or whatever the new finance minister did, was more towards market, more towards currency, and more towards looking at what foreign investors directly look at. Now I think the time has come that they have to look at the real economy and make things move on infrastructure, on power projects in particular, and also the investment cycle, which has been investment cycle has been impacted by multiple things. Interest rates have been very high. The government policy has been a bit paralytic till some time back. So I think now what everybody would like to see is some action which makes real economy move. particularly the large heavy sectors like capital goods, infrastructure, and these roads.
But is it
ports.
too early to buy infra because they still are beating down balance sheets just because reforms have kicked in? That will not repair the balance sheet for
I
any of
agree
the
with you.
asset owners.
See, there's a risk-reward payoff because the risk is high. Because if something does not move things or go wrong further again, then these stocks will be in doldrums. But I think if one has a 3 to 5 year view, then one should look at the balance sheets which are not overly leveraged, or because what happens in bad times, some of the companies become so dangerously leveraged that they find it difficult to recover even when times change. So one has to be cautious there. But I think for a typical, when we advise our research, is still skeptical and a bit cautious on infra and these kind of sectors.
The stocks you like, the ones we've discussed on the show last time, they both are at a new all-time high. First is Sun Pharma, the second is ITC. Do you think the big move is now behind Sun Pharma and ITC?
I would say that these stocks should still form part of your core portfolio because if you look at FMCG pack, then ITC is still at a P multiple which is lower than other peers. There's always worry about that more excise duty on cigarette, but I think that is already discounted, and the company is doing extremely well and a very steady growth. And the good thing about these two companies that today we live in a world where anything can change overnight. By the time I talk to you, 24 hours, the whole world can change. One negative news, something goes out of control and the whole thing can come down. So in this kind of environment, supposing I don't get 50% return, but I get 20-25%, that's fine. But if the market falls, then my capital should not get wiped out. So these two stocks have lower beta. They are relatively foolproof from the government, political, as well as global situation. And therefore, they should continue to be part of your core portfolio.
So if you have to construct a portfolio where you put in 100 and you get 130 back after 1 year, what would you like to buy in that portfolio?
So I would say that I'll still buy these FMCG and pharma that we spoke about. But maybe I'll give them 25% weightage, and the remaining 50%, I'll buy stock like cement stocks. I may buy I'll pick up stocks from mid-cap, and which is...
mid-cap cement?
No, mid-cap cements.
Okay.
Also like companies like, the cable TV, the Dish TV and Zee TV, because that digitization of home network is happening. There's a deadline in 2 phases by October 31st and March 31st. So I think that will drive the demand growth. And other than that, I'll look at bottom-up stock picking, but I can also look at some of the bank stocks and make a relatively balanced portfolio.
What about the business environment for IIFL? Have things turned the corner?
I think business environment for financial services has improved, and that we can see in market volumes.
When you say improved, you're not making losses?
No, we never made losses actually, touch wood. But all business segments, they're doing, and the profitability and the general sentiment and outlook is improving. I'm talking about the industry because company specific, it will not be appropriate for me to talk, but broadly, we are also a relatively larger player that will move more or less in tandem with industry. But I think all businesses, if you look at our life insurance, look at NBFC business or look at broking business, things are definitely improving.
So you would be hiring soon?
We have been hiring, and I think if things remain like this, touch wood, then we'll again need to hire people more aggressively. Hiring has slowed down in the last 2-3 years, and if you see financial services, telecom, retail, all of them, they were the major employer or major recruiter from MBA colleges, engineering colleges in the last 5 years. So if you really look at MBA colleges, then these last 2 years have been very terrible. In fact, some of the MBA colleges say that they're not getting students also. So I think that hopefully that feel-good factor has come back, and that should sustain and continue. We may not hire at a pace which is frantic. We'll be cautious now, because we have seen the last 4 years how difficult they have been. But I think that the number of manpower will start moving up, and therefore the employment scenario, at least in this sector, should look better.
So I'm just going to extend a definition of financial sector. Let's talk about what do you like within the financial sector. Some like private banks, some are bullish on PSU banks, they are attractive, and others are keeping it simple and they're simply buying NBFCs. What do you like, and what should investors buy when it comes to financials?
I think you should buy a mix of these three.
All three.
So PSU banks also, although there are some apprehensions that the second quarter result might be crude surprises in some of the banks, but there are a large number of banks that are relatively safe and good banks and available at valuations which are very attractive. So at this point in time, you can make a mix of private banks, PSU banks, and good NBFC companies.
Give me an example of an NBFC which is attractive.
NBFCs like Shriram Transport, Bajaj Finance, they are fairly attractive. Mahindra Financial Services, all these three NBFCs look pretty good.
Are there any structural themes which you are betting on? Because in markets, courses remain the same, but it's only horses which change with time.
So I think one should be looking at the developments carefully, because the GST, if say this political storm blows over and the reforms continue, then at appropriate time one has to take slight bit of risk and increase the weightage in high beta stocks and capital goods, infra and real estate, because the returns can be exceptionally quick. So at least maybe 20-25% of your portfolio can be these kind of fire stocks where.
But in the near term, you think the best of the beta trade is behind us?
I think in the near term, still stick to the defensives, that we spoke about, FMCG, pharma, and some plays in mid-cap cement. In cement, what has happened that in last 3 years, very little new capacity has come up. So most of the cement companies, and particularly north-based, they are operating at 100% capacity utilization. It's a commodity at the end of the day. The demand is fairly inelastic, because when you do a construction of a house or a factory or the cost of cement is just about say 5% or thereabout. So it's not it's going to change your decision. And if there's a short supply, then obviously the prices rise. And also thermal coal prices have gone down, which has also benefited them in terms of margin. And the cement companies are quoting at very low P multiple, 4 times, 5 times, mid cap. And the big ones also at 8 times, 9 times.
But that could be because they're at the peak of the cycle. At the peak of the cycle, commodities always look cheap.
I think if we talk to our analyst believes that the peak of cycle in terms of commodity prices and the margin is still some time away. Because even if you decide to set up capacity today, it will take 2 to 3 years. So given the situation that exists today, maybe next 2 to 3 years you'll see a very good time for cement companies.
So at IIFL, what are your top contra ideas where you are leaning one way and others are leaning the other way?
I think cement has been one such sector where we took a call much earlier on the sector, and
it was a great call.
And in fact, till now it has turned out to be well, and we continue to be on that. Other than that, some of the mid caps that I spoke to you about, these cable TV or digital TV cable kind of companies, and some of the PSU banks and private sector banks. I think more or less, these are the.
You still
we continue to be bullish on FMCG. Now companies like Imami, companies like ITC or this Glaxo GSK. So we have been Hindustan Lever. We have been recommending these stocks pretty consistently, and we are not. There are many brokerages that have, I think, started recommending infra, capital goods, and real estate. But so to that extent, we are not with with them.
A call which has not worked for you, and I just want to revisit that one, is on mobile.
On mobile passed through certain management challenges, as you know, that in terms of. But I think the company's business model is still good, and this is one company that can get sold. And whenever that kind of M&A deal happens, I think there can be significant appreciation. So this is one of the smaller or mid-cap idea, which is high beta, and I think one should continue to hold on, because the management challenge has brought down the value, whatever happened in the company. But I think the business model and the product still have a lot of value, which is not yet seen in the market cap.
A freak trade last Friday shook up the entire market. Why is that every 6 months, every 8 months, we get one freak trade in India?
I think, yeah, so you get one freak trade, there's the flip side of the story. But when the stock markets have become as large as these, that 20-30 billions of trades happen, that the frequency of this trade is really not alarming. And the good thing is that our entire system, the SEBI, exchanges and brokers, have been able to come out of each of them quite unscathed and in a fairly graceful manner. So none of these freak trades or none of these, the very developed stock markets like Japan and maybe some in Europe have been shut down many times for freak trades. At least in Indian context, shut down for 10-15 minutes is inconsequential. But I think it's a commendable job that our exchanges, regulator as well as brokers have done, that they come out of these kind of freak trades and accidents and errors pretty quickly and pretty nicely.
As an industry spokesperson, as a representative of the Indian brokerage industry, how do you think this problem needs to be tackled, and whom would you support in this?
I think, see, it's a human error, and all of us are human beings, and we can do errors at some point in time. So if there is not intentional manipulation, then always it's just basic logic by which human beings will work. If there's an error which is unintentional, then you should not be penalized, and to whatever extent we can work and try and mitigate the damage and the loss is good, is fair. I mean, it's something which is, if somebody does it, which is a manipulation, then obviously there's no pardon and there's no mercy on that. But a freak error, should be condoned and should be viewed more leniently as compared to, anything else. So in this case, I think, they've been able to find a solution that most of the brokers that have benefited are willing to, part with the gain and make sure that the broking company that had error, the loss is mitigated.